Okay, so let's dive in. We're looking today at this fascinating intersection, really, where finance meets faith. How do these, principles from centuries ago actually apply to buying stocks today?
It's a great question, and it shows how deeply held beliefs really can and do shape financial decisions. Even in, the modern global market, it needs a specific kind of framework.
Absolutely. And that framework is what we're zeroing in on. For this deep dive, we're using a specific set of rules, a standard actually used by the Dubai financial market that lays out how to determine if a company's shares are Sharia compliant.
hmm And our mission here really is to unpack that standard for you. We want to pull out the core criteria, the things that decide if a stock is permissible for a Muslim investor under these particular rules. So you get a clear picture of this specialized financial area.
Right. Get the essence without getting totally bogged down.
Yeah.
So how does the standard actually work? What's the mechanism?
Well, the standard sets out these controls, that's the term they use, and in Arabic. Think of them as specific rules and checks that are applied regularly. They look at what a company does, how its finances stack up. It's a whole screening process.
Controls. Got it. So where does that screening start? What's control number one?
The absolute foundation is what they call the activity control. The principle is pretty simple. The company's main purpose, its core business, has to be compliant with Sharia.
Okay, makes sense. You wouldn't invest in, say, a brewery if alcohol is prohibited, but how deep does that check go?
Well, first they look at the official documents,
Mm-hmm.
the company's articles of association, that kind of thing. If the purpose stated there is clearly okay, great.
Have it.
But if those documents are maybe a bit vague, or if they mention things that could be non-compliant alongside compliant activities, then you have to verify what the company actually does. You can't just take the paperwork at face value.
Okay. So you might need to look at their real operations, maybe even their financial statements.
Exactly. Financial statements can reveal where the money is actually coming from. It's about substance over form, you could say.
Right. So what kind of activities does this standard specifically call out as definite no-goes?
Right.
Things that would make a stock non-compliant right away.
There's a list, of course. Some key ones are dealing with interest-based finance. So think conventional banks, lending money for interest.
And core prohibition, yeah.
Definitely. Also conventional insurance companies or conventional investment funds. Then there are businesses dealing in things that are inherently forbidden: cork products, alcohol, tobacco, narcotics, unless maybe for approved medical use.
Okay.
Gambling in any form is out. Certain financial contracts that conflict with Sharia rules, like ones not based on a real exchange of value. Dealing in prohibited items like certain weapons or anything harming human dignity, the standard mentions things like human trafficking or prostitution.
Wow, it's quite comprehensive.
It is. It also includes operating places like hotels or resorts if they heavily feature or provide prohibited services, things that violate Islamic values like serving alcohol widely or facilitating things like gambling or pornography. Even activities harmful to the environment or health are mentioned.
So it's broad. The business has to pass this fundamental activity test, both on paper and in practice. What's next? Assuming the core business is okay.
Then you move to the financials. And the first big financial check is the borrowing control. Borrowing control.
Borrowing. Okay, this is where interest often comes in, which we know is a major issue in Islamic finance. How does the standard handle companies that might already have some conventional debt?
That's a really important point. See, borrowing with interest is prohibited in principle, but this standard is often used to screen companies already operating in the conventional market. So it sets a tolerance level, a threshold.
A threshold.
Yeah. The rule is a company's average interest-based borrowing shouldn't be more than 30% of its total assets.
30%. So it's not saying interest is okay, but it's a practical limit for screening existing companies, like acknowledging reality.
Exactly that. It's a tolerance threshold for the screening process. If a company's borrowing is above that 30% mark, its shares are considered non-compliant based on this standard.
And how do they calculate that average borrowing? Is it just looking at the debt on one particular day?
No, it's more nuanced. The standard specifies it should be a weighted average over the financial period being reviewed. So it considers both the amount of each interest-bearing loan and how long that loan was outstanding during that period.
I see. So a big loan taken out just before year-end has less impact than a smaller loan held all year.
Kind of, yeah. It reflects the company's exposure to interest-bearing debt over the whole period relative to its total assets over that same period.
Got it. Weighted exposure over time. And what counts as this prohibited borrowing? Just bank loans?
It's pretty broad. Any debt from non-compliant contracts. So yes, conventional bank loans, charging interest, issuing conventional bonds, using other prohibited financial instruments that has essentially function like interest-bearing debt.
Okay, that makes sense. And what if the company owns parts of other companies, like subsidiaries? Does that complicate the 30% calculation?
Oh, absolutely. The standard mentions that if the company has significant stakes in subsidiaries or other entities with their own finances, the calculation gets more complex. You generally need to proportionally include the parent company's share of the borrowing and assets from those entities. It tries to get a consolidated view.
Right. Prevents hiding debt in subsidiaries. Okay, so that covers borrowing. What about the other side, lending or holding assets that earn interest?
That brings us to the third control, the lending control, the korsha. And you might guess, it's basically the mirror image of the borrowing rule.
Another 30% threshold.
Exactly. A company's average interest-based lending, or assets that generate prohibited income like interest, should also not exceed 30% of its total assets.
Same logic, same threshold, just applied to assets generating interest instead of liabilities incurring it.
Precisely. And again, the standard is clear. Lending with interest is fundamentally prohibited. This 30% is a screening tolerance. And importantly, any actual profit earned from such interest. Well, that ties into a later control about purification.
Ah, okay, we'll get to purification. Is the average calculation the same here too, weighted by duration?
Yes, the principle is identical. It's a weighted average over the financial period, looking at the company's exposure to these types of assets over time.
And what kind of assets are we talking about here? What falls into this prohibited category for the 30% test?
Things like cash deposited in conventional bank accounts that earn interest, investments in conventional interest-bearing securities, think treasury bills, corporate bonds, money invested in conventional funds that themselves invest in interest-bearing instruments. Basically, any asset held primarily to generate interest income.
Okay. And the complexity with subsidiaries applies here too, I assume.
Yes, same principle. You'd need to look through to the holdings in subsidiaries proportionally.
All right, so we have the core business check. Then these two 30% financial ratio tests on borrowing and lending interest-earning assets. What if a company is okay on those but still gets some income from a non-compliant source? Maybe a tiny side business or some specific transaction.
Good question. That's where the fourth control comes in, the forbidden income control. This one looks at income from prohibited activities that aren't already captured by those main 30% asset tests, especially the incidental interest income.
So kind of a catch-all for other types of bad income.
Sort of, yeah. The rule here is that the income generated from these other non-compliant sources shouldn't exceed 10% of the company's total income.
10% this time, lower threshold. What kind of income are we talking about?
This could be revenue from, say, selling small amounts of prohibited goods like alcohol or pork, if it's not the main business, but still shows up in the revenue lines. It could be profits made from investing in the shares of other non-compliant companies. Income from certain financial contracts considered non-compliant, like maybe certain forward currency contracts. Even things like late fees or penalties charged on debt contracts, or rental income from a property if it's knowingly leased out for a prohibited purpose.
So it sweeps up various smaller streams of non-compliant revenue, capped at 10% of total income. Now, you mentioned purification earlier. What happens if a company does have some of this prohibited income? Maybe it's incidental interest below the 30% asset limit or this other stuff below the 10% income limit. As a shareholder, do I just ignore it?
No, absolutely not. This is critical. It leads to the fifth control, the purification control. Shows that if the company has any income deemed prohibited, even if it's within those tolerance thresholds, the shareholder has a responsibility to purify their portion of that income.
Purify. How does that work? How do I know how much my portion is?
The standard lays out the calculation. You take the company's total prohibited income, that's the sum of the incidental interest income, plus any of that other forbidden income caught by the 10% rule, and you divide that total amount by the total number of shares the company's issued.
Okay, total prohibited income divided by total shares. That gives a per share amount.
Exactly. That gives you the amount per share that needs to be purified. So if you own 100 shares, you multiply that per share amount by 100.
Got it. And when do I have to do this purification? Is it ongoing?
Typically, it's linked to when dividends are distributed. That's often when the company's results, including any prohibited income sources, become clear for the period.
Is there any way out of this? What if I sell the shares?
Yes. There's a key point in the standard. If you sell your shares before the dividend declaration date for that period, You generally aren't obligated to purify the income related to that upcoming dividend. The obligation usually falls on whoever holds the shares when the dividend is actually announced or paid.
Okay, that's important. Now, the purified amount. What do I do with that money? Can I give it to my favorite charity, use it to pay off some bills?
This is crucial, and the standard is very clear, because the money itself comes from an impermissible source. You absolutely cannot use it for your own personal benefit. That means you can't use it to pay your taxes, settle your debts, or buy things for yourself.
So, no personal benefit at all. What about charity?
You also shouldn't intend it as a normal act of charity where you're seeking spiritual reward, because the source is illegitimate. The idea is disposal. You need to get rid of it. Often it's directed towards public good or given to the poor and needy, but the intention isn't personal gain or reward. It's simply cleansing your investment from that tainted portion.
Right. Disposal, not donation for merit. That's a very specific distinction.
It is. It underscores the seriousness of avoiding impermissible gains.
Okay, so we've covered the business activity, the financial structure limits, and how shareholders handle any prohibited income that slips through. What about the act of buying and selling the shares itself? Are there rules about how you trade?
Yes, absolutely. That's the sixth control. Investment methods control the digital branch. The rule is quite direct. You can't buy or sell shares using any methods or contracts that are themselves non-compliant with Sharia.
What kind of trading methods does the standard rule out?
It explicitly lists several common practices, things like financial derivatives, futures, options, financial exchange contracts, trades based purely on indices, margin trading where you borrow to invest.
So leveraging and speculation seem to be the targets there.
Largely, yes. It also prohibits short selling, buying shares with interest-based loans, lending or renting out your shares, dealing in specific types like preferred shares, which might have debt-like characteristics, and using certain specific contracts like salon contracts for shares.
It really seems to push towards straightforward ownership, buying shares with your own capital, rather than complex or leveraged strategies.
That's a good way to put it. The focus is on compliant methods of acquisition and disposal.
Okay, so we have all these controls. How often does a company get checked against them? Is it just once when it's first assessed?
Oh no, it's definitely an ongoing process. This is covered by the seventh control. Periodic review, tanshi tiaye. A company's compliance status isn't static. It's reviewed and updated based on its latest audited financial statements.
Audited financials. That's the key data source.
Yes. Audited statements are the primary basis for determining compliance with those financial ratios and income limits.
And how often does that review typically happen? Annually.
The standard says the reevaluation happens whenever new audited financials are released. For most publicly listed companies, that's usually quarterly. The standard specifically notes that unaudited statements aren't typically used for the formal compliance decision.
Quarterly review based on audited numbers. Okay. Now, what if I'm holding shares in a company that was compliant, but then its new quarterly results come out and oops, it now fails one of these tests? Maybe its debt went over 30%. What do I do?
The standard is quite clear. The investor should sell those shares upon becoming aware of the non-compliance.
Immediately. What if the share price has dropped and I lose money?
There's a practical allowance for that exact situation. If selling immediately would result in a capital loss, meaning selling below your purchase price, the standard allows a grace period. You can wait up to 30 days from the date you learned about the non-compliance to sell.
30 days grace period if selling immediately means a loss? That seems reasonable.
It does offer some flexibility, and there's another interesting point related to this grace period. If you do sell within those 30 days, even if you happen to make a profit during that short window, the standard says you are not required to purify that specific profit made during the grace period sale. The obligation is to exit the non-compliant position.
Interesting. The exit takes priority over purification in that specific 30-day loss scenario. Is there any monitoring between these quarterly financial releases?
Yes, the standard does mention daily monitoring of market data. This would include things like share prices, but also corporate actions, mergers, acquisitions, stock splits, dividend announcements. This isn't for the main compliance re-rating, but more for tracking things that could impact compliance status between reports, or, crucially, for gathering the data needed to calculate purification amounts accurately when dividends are announced.
So, continuous monitoring for certain data points, but the main compliance check is tied to those audited quarterly results.
That's the core process, yes. Audited financials are paramount. The standard does acknowledge that if audited data isn't available for some reason, Other sources might be used like reports for that industry sector or even estimations, but audited is the gold standard.
Okay, so let's pull this all together for you, the listener. Why does knowing all this intricate detail matter if you're thinking about Sharia-compliant investing?
Well, I think it shows you just how systematic and rigorous this specific approach is. It's not just about avoiding certain industries. It's a detailed quantitative screening process applied to a company's actual financial health and operations, viewed through a specific ethical lens defined by these controls.
It really highlights that it's more than just a label. There's a methodology behind it based on the company's real numbers and activities.
Exactly. It's about ensuring that the investment aligns with the underlying principles in a verifiable way.
Right. So, to recap for everyone, this deep dive into the standard showed us these key pillars. First, checking the core business activity is compliant. Second and third, keeping that interest-based borrowing and interest-generating lending or assets each below 30% of total assets, calculated on a weighted average basis. Fourth, capping other non-core prohibited income at 10% of total income. Fifth, the crucial step of purifying your share of any prohibited income, mainly when dividends are announced, by disposing of it without personal benefit. Sixth, making sure you only use Sharia-approved methods to actually buy and sell the shares. And seventh, that all of this is subject to regular review, typically quarterly, based on audited financial statements, with clear rules on what to do if a company falls out of compliance.
Understanding these specifics really gives you a concrete insight into how these financial principles are put into action in the real world of stock investing.
It certainly does. And that brings us to a final thought for you to maybe mull over. When you see the level of detail and the systematic screening involved in this particular standard, aiming to ensure investments meet specific ethical criteria, does it make you wonder how other principle-based investment strategies, maybe focused on environmental impact, social goals, or different ethical frameworks, could perhaps learn from or adapt this kind of rigorous, rules-based approach to ensure their own integrity?